Welcome back. Our last project for today is on the Fall of WorldCom. Our presenters are Sara Wilson and Sydney Johnston. Their mentor is Dr. Vicky Eidson. I'll send it over to you, ladies.
Hello, my name is Sara Wilson.
My name is Sydney Johnston.
And we are both senior accounting majors here at QU, and today we will be presenting on the Fall of WorldCom.
All right, so I'm going to start with who were they. So WorldCom was an American telecommunications company, and they were founded in 1983 in Clinton, Mississippi, under the name LDDS. And then they officially became WorldCom in 1995. During the late 1990s, they were the largest telecom company in the world, and they experienced rapid growth through a series of mergers and acquisitions. However, these were very poorly handled, and they took on a lot of debt from the mergers, and there was a lack of integration, and these were the perfect conditions for fraud to occur. You may be familiar with this case from the book that Cynthia Cooper wrote about her journey as a corporate whistleblower. And then these were some key players in the case. So up at the top there is Bernie Ebbers, and he was the CEO. One interesting thing about Bernie is that he did not have a degree in business. He actually had a degree in physical education. And because of this, he was not familiar with the term internal controls, and he did not like that it was used in auditing reports. And then is CFO Scott Sullivan, and he was the mastermind behind all the fraud. He was also named the country's best CFO in 1998 by CFO magazine. And then David Myers was the senior vice president and controller, and he was the one passing down orders from Scott Sullivan to the other accountants. And then Buford Yates was the director of general accounting. Bettyinson was the accountant actually making the fraudulent journal entries. And Cynthia Cooper was the director of internal auditing, and she was the one who found out about the fraud and was the whistleblower. And then Kim M.I. was a budget analyst and then engineer manager, and he kind of discovered a situation of fraud, but his managers shut him down and he was eventually fired. And then this organizational chart shows the chain of command at WorldCom. So as you can see, Bettyinson was at the very bottom. She reported to Buford Yates, who reported to David Myers, who directly reported to Scott Sullivan, the mastermind behind all the fraud. Okay.
I will be going over an overview of the fraud case before getting into some of the details of it. So the fraud had started with engineer manager Kim M.I. being asked to conduct improper cost-cutting measures and to misclassify costs in order to artificially bring up the reduced profits that WorldCom was experiencing. However, Kim M.I. refused to perform these cost-cutting measures. Then CFO Scott Sullivan told the accounting department to make a one-time adjustment to the reserve accounts in order to offset these reduced earnings. However, in future quarters, the earnings were not improving, so CFO Sullivan instructed the accountants to shift the line costs, which were recorded as expenses, to an asset account, which were then amortized over time. The director of general accounting, Yates, and all of the accountants originally objected to CFO Sullivan's plan of unethically recording the line costs as assets, but eventually went along with it, even though they felt uncomfortable. Accountant Bettyinson was the one who made the fraudulent accounting entries to record these transactions and transfer the line costs from an expense to an asset. Eventually, the fraud was uncovered by internal auditor Cynthia Cooper and her team through an investigation of the accounting entries, and she blew the whistle to the audit committee. Moving on to some of the more details of the fraud. So we're going to start with Kim M.I., who started out at WorldCom as a budget analyst. During this time, he noticed unethically close relationships between company executives and their vendors and contractors who were also paid excessive rates by WorldCom. When he questioned these relationships, management told him to let it be, and he was threatened with termination at this time. However, instead of being terminated, he was simply transferred to another department and promoted multiple times up to the position of engineer manager. In 2000, business began to slow down because of the dot-com and telecom bubbles bursting. The bubbles formed when the internet came into existence because of a huge influx of new telecom companies trying to expand their networks to reach the new consumers. However, the market could not support all of these companies, which caused the bubble to burst and many of the companies to fail. Now, the slowdown of business at Enron caused expenses to increase faster than revenues, which led to top management requesting improper cost-cutting measures. In the late 2000s, Kim and I was asked to misclassify costs by shifting labor expenses from one category to another in order to artificially boost the bottom line to show a profit rather than a loss. Kim and I did not follow this instruction and blew the whistle to the company's COO, or Chief Operating Officer, which caused him to then be fired. And it was noted that no one outside of his department heard about his whistleblow or that he was fired because of this. Moving on to Bettyinsen's role. She was an accountant at Enron, and she was a loyal employee who was known for doing what she was told to do. In September of 2000, as stated in the slide before, expenses were increasing faster than revenue, and WorldCom was $828 million off from their expected earnings targets from Wall Street. Because of this, CFO Scott Sullivan pressed Controller Myers and Director Yates to make adjustments to reduce the reserve accounts for line costs in order to cover this shortfall. Now, the reserve accounts are set aside based on estimates of potential losses for the company. However, you need to have sufficient enough reason to reduce these accounts, and not meeting earnings targets is not sufficient enough reason. The Director of Accounting, Buford Yates, and Accountant Bettyinson both had reservations about decreasing the reserve accounts. However, CFO Scott Sullivan said that it was just a one-time adjustment and that they were doing nothing illegal. So Director Yates instructed Vincent and the other accountants to reduce the reserve accounts for the line costs in order to cover this shortfall. Accountant Bettyinson considered resigning at this point because she felt so uncomfortable making these journal entries. However, her family depended on her for her salary and her health insurance, so she was not able to resign. In April of 2001, WorldCom again was $771 million off from their expected earnings targets. However, this time the reserve pools were not large enough to cover the loss, so CFO Sullivan instructed Director Yates and the other accountants to move line costs, which were recorded as expenses, to asset accounts under the term prepaid capacity. This made WorldCom's income higher and allowed the costs to be spread out over a period of years instead of being expensed in the period that they actually occurred. Everyone in the general accounting department knew that this was fraudulent accounting, but they all felt cornered to make the journal entries. The accounting team proceeded to identify which asset accounts to use, and Bettyinson was the one who ended up making the journal entry to transfer the $771 million through backdated entries. These entries changed the company's fiscal results to show a healthy and profitable company when WorldCom was actually close to bankruptcy. And these entries to shift line costs continued each quarter until April of 2002. Moving on to the uncovering of the fraud and Cynthia Cooper's role in this. So as stated earlier, Cynthia Cooper was the head of WorldCom's internal audit department. Now, this instance of fraud that we are talking about today of shifting line costs from an expense to an asset account is not the only time that Cooper and her team uncovered improper accounting procedures at WorldCom. This was a reoccurring event and not just a one-time thing. The internal auditor, Cynthia Cooper, heard about the engineer manager, Kim and Mai's allegations of fraud through the grapevine at the company and decided to investigate his accusations. She was also informed that the general accounting department had moved $400 million from the reserve account to falsify WorldCom's income statement. When looking into Kim and Mai's claims in May of 2002, the internal auditors found a number of accounting entries to prepaid capacity, which is an asset account, that totaled up to $1.4 billion just from the first quarter of 2002. No one on the internal audit team had heard of the term prepaid capacity before, and there were also no documents to back up these entries like there normally should be. Also, during the investigation, The internal audit team's access to the accounting system at WorldCom was cut by Controller David Myers to try to keep them from finding the fraudulent accounting entries. However, this was just a short-term setback, and they were able to regain access a little bit later on. Eventually, through their investigation, the internal audit team uncovered $3.9 billion that had been taken out of the operating expenses and transferred into prepaid capacity, which is an asset account dating back to the first quarter of 2001. They were also able to identify the journal entries where the accountants inappropriately decreased the reserve accounts to make up for losses. Continuing on, with these findings, internal auditor Cooper took this information to the company's new external auditors, KPMG, and they confirmed her findings that WorldCom's actions were fraudulent. It is noted that Arthur Anderson was the external auditor for WorldCom during the period of the fraudulent financial accounting. However, they were fired early in 2002 because of the Enron scandal, and Sydney will get into that a little bit later on. So with this confirmation that they were correct, Cynthia Cooper and the internal audit team started to ask the accountants for an explanation about the prepaid capacity. They specifically asked accountant Bettyinson, and Vinson just referred Cooper to her boss, Director Buford Yates. Director Buford Yates then referred Cooper to his boss, Controller David Myers. Cooper and Controller David Myers actually had a meeting where Myers had told Cooper that she was wasting her time investigating prepaid capacity. However, after their meeting, Myers told CFO Scott Sullivan that the internal audit team knew about the questionable accounting entries that were being made to prepaid capacity. On June 11th of 2002, Cooper met with CFO Scott Sullivan, and he asked her to delay her audit of prepaid capacity, and he also said that he was going to hold off on some of her staff's promotions until he learned more about their current investigation. He had also mentioned to Cynthia that the audit committee chair that she had reported to for the last 8 years would be leaving the committee. This would take away the internal audit department's independence because all of the other people on the board of directors were friends or acquaintances with either CEO Bernie Ebbers or CFO Scott Sullivan. Instead of following the advice of CFO Sullivan, the next day, Cooper went and informed the audit committee chair about the findings from the internal audit department's investigation into prepaid capacity. Then, at the audit committee meeting on June 20th of 2002, Cooper officially blew the whistle on the fraudulent accounting of WorldCom. CFO Scott Sullivan was actually in attendance and tried to explain and defend these journal entries, but he couldn't, and he was eventually fired by the board of directors 4 days later. And it was also noted that Controller David Myers resigned the same day that CFO Scott Sullivan was fired. Finally, on June 25th of 2002, WorldCom's board of directors announced that WorldCom had inflated its profits by $3.8 billion over the previous 5 quarters. Moving on to the SEC's investigation. So, internal auditor Cynthia Cooper's report, along with the board of directors' statement, caused the SEC to launch its own investigation into WorldCom's accounting practices. And they found that the company had overstated its assets by $11 billion because they moved expenses off of the income statement and onto the balance sheet as an asset. The SEC then charged WorldCom with civil fraud, and the two reached a settlement of $2.25 billion. This investigation and its findings caused several key executives to be indicted on charges of securities fraud, conspiracy, and filing false documents with regulators. And these charges will be expanded on in just a bit. After the fraud. So after the fraud was initially uncovered, WorldCom filed for Chapter 11 bankruptcy. During the bankruptcy restructuring process, WorldCom changed its name to MCI in hopes of distancing itself from the still mounting accounting fraud. MCI was the most recent and largest acquisition that WorldCom had made before the fraud started, which was in 1998. The headquarters for the company also moved from Clinton, Mississippi to Ashburn, Virginia. However, MCI was eventually acquired by Verizon at the beginning of 2006 after just a few years of operation post-bankruptcy. And then this is a quote from Cynthia Cooper. It reads, "Neither the fraud nor the discovery of it caused WorldCom's collapse. In fact, the fraud simply masked the true state of the business, and WorldCom should have gone into bankruptcy long before it did." Now, this chart shows the actual income that WorldCom should have reported versus the reported income. So you can see in their first time that they misstated their financial statements, they didn't even have a loss. They didn't have a loss until the second quarter of 2001, and they should have recorded a $401 million loss when they actually recorded $159 million in profits. And I'll give you just a second to look at that.
All right, now I'm going to go over how the key players benefited in this case. So accountant Bettyinson received a $30,000 salary increase in 2 promotions. And then CFO Scott Sullivan had a $700,000 salary plus $10 million in bonuses and stock options. And then for everybody else involved, obviously the stock price went up because of their performance, and they were able to sell their shares at a gain. And then WorldCom was able to stay in business, and they were able to keep their jobs and continue to receive their salary. And then what happened to them? So CEO Bernie Ebbers was sentenced to 25 years in prison. He actually only served 13 though, because he got out early because his health was rapidly declining, and he actually died 2 months after being released. And then CFO Scott Sullivan was sentenced to 5 years, but he only served 4 and then had 1 year of home confinement. And even though he was the mastermind behind all the fraud, he only got 5 years because he helped to bring Bernie Ebbers down. And then Controller David Meyer and Director of Accounting Buford Yates both received 1 year and a day in prison. And then Accountant Bettyinson received 5 months. And then the internal auditor, Cynthia Cooper, obviously did not receive any jail time, but she was Time Magazine's 2002 Person of the Year. All right, and then these fraud risk factors provide red flags to auditors that fraud could be occurring. So for incentives, rapid changes in the environment. When the dot-com and telecom bubble was growing fast, they needed to stay on top of their competition. And then when there were significant declines in customer demand, that was when the dot-com and telecom bubble burst. So a lot of companies started to go bankrupt, and WorldCom did not want to be one of them. And then operating losses making the threat of bankruptcy imminent. WorldCom would have gone at bankrupt sooner had they not misstated their financial statements. And then for opportunities, the domination of management by a single person or small group. So at WorldCom, Scott Sullivan had all the power, and his word was always to be followed, even if you thought it was fraudulent. And then oversight by board not effective. So WorldCom's audit committee hardly ever met. They only met about 3 hours per year, and they weren't really involved in the company's workings. And then inadequate monitoring of controls. So the control departments were very weak, and no other departments were able to catch the fraud. And then attitudes and rationalizations. So the communication of inappropriate values or ethical standards that aren't effective. So as I said earlier, the word of top management was to be followed, especially Scott Sullivan. And then management failing to remedy deficiencies in internal control. Many people knew that the fraud was occurring, Buford Yates, David Myers, Bettyinson, but they just went along with it. They didn't do anything or report it. And then excessive interest by management in increasing the entity's stock price. So they obviously wanted the company to do well, and they were willing to do anything to have good earnings. And then how the auditors failed. So as Sara already mentioned, Arthur Andersen was WorldCom's external auditors. And Arthur Andersen claims that WorldCom executives, specifically Scott Sullivan, withheld financial information, such as the fraudulent journal entries. However, experts say that the manipulation of the books should have been very evident. After all, it was $3.8 billion, so that is a lot of money to miss. And then the SEC didn't actually accuse Arthur Andersen of any wrongdoing. This could have been because it was right around the time of Enron, so Arthur Andersen was already going to go down. And then it is important to mention that Arthur Andersen did audit other telecom firms that had auditing or accounting irregularities, so it was a pattern for them. And then Arthur Andersen was fired by WorldCom in the early spring of 2002, and they were replaced by KPMG. And then for auditing standards, so AUC 200 A32 says that audit evidence is necessary to support the auditor's opinion. And basically, the more risk in a company means that you need more audit evidence, and WorldCom was a very risky company due to their rapid growth and large number of acquisitions. However, it is said that Cynthia Cooper claimed that Arthur Andersen over-relied on WorldCom's internal controls instead of doing substantive testing. And then in summary, so they inflated assets by $11 billion. And this was one of the largest accounting fraud cases at the time. And they did this by underreporting line costs by capitalizing them instead of expensing. And they inflated revenues by making false entries. And the scandal was discovered by the Internal Audit Department, specifically Cynthia Cooper. 5 employees served time in prison as a result of the case. And 30,000 people lost their jobs, and over $180 billion was lost by investors. And then there are references. Does anybody have any questions?
Could you remind me again of the logic behind a 1 year and 1 day sentence? I know you discussed it before, but I can't quite remember.
So in order to be eligible for early release, they have to serve at least a year in prison. So they wouldn't have been eligible to get out early had they just served a year or less.
So related to the person that ended up calling out the ethical issues who later got fired, so he didn't report it to like anybody that about the business being unethical, like to, I don't know specifically who would get reported for whoever does the auditing of the financial statements. He never told any like people about that?
So he actually told WorldCom's COO, which is Chief Operating Officer, and that would have been his boss at the time. He probably, since he was an engineer manager, he probably did not have any contact with the external auditors of WorldCom, so he might not have exactly known who he should have reported it to. And then since he was fired, he did talk about it a little bit, but it was kind of known that he kind of left WorldCom and just continued on with the rest of his life.
He kind of just distanced himself from the company in general.
So, why did they want to misstate their revenue when they had no losses?
So they misstated their revenue when they didn't have any losses because they wanted to meet the earnings targets set by the investors and top people on Wall Street. So if they had kept up with their estimates of how much they would have made, then that would mean that people would want to invest in their company more because they're meeting their estimates or even exceeding their estimates instead of falling short. Because if you're falling short of your estimates, it typically means that you are kind of falling back as a company and maybe leading into bankruptcy like a lot of the other telecom companies were.
So if the dot-com bubble was bursting and, I mean, with cross-sectional analysis, why weren't any more red flags like noticed about them doing so well when everyone else was doing so poorly?
We kind of think that that has to do with Arthur Andersen being their external auditor, just because of what has been said previously about the whole Enron scandal and them kind of being over top. Arthur Andersen necessarily wouldn't have been looking for those things because it is proven that they didn't look for those things in other companies. However, WorldCom was also making a lot of acquisitions of some of these other companies, and so compiling all those companies together would have allowed them to have some higher earnings than the rest of the smaller companies that were going bankrupt. Thank you.
Thank you.
Thank you, Sara and Sydney. This concludes day 3 of the Academic Symposium. We'd like to invite you back tomorrow for our poster presentations, which will begin at 10 o'clock. Those are presentations that you can go up to a poster, you can hear about their research and move on to the next one. So you're welcome anytime between 10 and 12. Lunch will begin at noon with a presentation from QU Professor Joe Coelho. Awards will begin at 1 o'clock, and we hope to see you back tomorrow. Thanks for joining us.